Okay, so let me just quickly run through what we did last week. So we started our derivative class last week. And we spoke about what derivatives are. And I said, just as the name is, derivative, it derives itself or derives its value from something else. So we said, what are those things that it derives its value from? Pension, shares, bonds, stocks. We mentioned different things. So we gave an example of forward contracts. Spoke about forward contracts. Spoke about futures. Then swaps. Basically options. Okay. So for the forward price, we said it's basically everything we're learning in derivative. It's looking at two different sides. So this forward is I want to buy a laptop.
Hello, sir.
Yeah? Okay, so we said that if you are trying to buy something, go into let's say laptop, and you say, okay, I need a laptop. Today we are in March now, and you say you need a laptop in June. So forward contract is saying, okay, I want to buy a laptop from West, and I say, West is abroad, I'm in Nigeria. And I say, okay, West, I want to buy this from you. And West says, okay. But I say, oh, I need it in June. And West says, okay, let's agree on a price that will buy this thing from you in June. And let's say the cost of the laptop today is 200,000 naira. So this is the price today, which we call the spot price. But we both agree that in 6 months' time, he's going to give me this laptop for 250,000. So this 250K is the forward price. Is the price we are agreeing today for a transaction that will happen in the future. So this is the forward price. This is the spot price. Spot price is what does that item cost today. So I now tell Wes that Wes, I'm going to buy this laptop from you for 250K in 3 months' time. So of course, looking at this deal, for Wes to agree, it means it must be beneficial to him. For me to suggest 250K, it means it must be beneficial to him. So what does it mean for two of us? Me who am the buyer, because I said I want to buy 250K, because I believe that most likely by June, the price of this laptop will be above 250K. That's why I think it's a good deal for me to lock the transaction with West today, instead of waiting for June and then walk to West and say, okay, West, this is the money, give me the laptop today. So I believe this is going to favor me. That's why I'm going into it. West, on the other hand, believes that the price of laptops will come down. So he says it's better for me to lock this to 250K because in June, he probably believes that laptop will be 150K. So he sees this as a good deal. I see this as a good deal. Then we go into that transaction. We've agreed on the settlement date, which is June. We've agreed on the forward price, which is 250K. Then, depending on the size, if it's one laptop I want or 10 laptops, that size is now what we call the contract size. Now, at the end of the day, June now comes. We are now in June. So there are three possibilities that can happen in June. One, the price of laptop is actually 250K. In that case, I did not lose, West did not lose. Because even if West goes to the market, it's still 250K we get. But we now take it to scenario 1. Scenario 2, scenario 1 is 250K. Scenario 2, the price has dropped to 180K. Now, what does this mean? It means that the spot price as at June, meaning, what does that mean? The price you will get it in the market as at June is now 180K. With this transaction, who has gained, who has lost? I have lost because something I should easily walk to Computer Village and buy for 180K. I'm buying it for 250k because I entered a contract with Wes. Wes is happy because all the other laptops in the shop, we sell it at 180k. But this particular one he has agreed with me, we will sell at 250k. So Wes is happy. So that's scenario 2. Scenario 3, let's say it's 300k. So in this case, me the buyer, I'm very happy because if I go outside, I will buy it for 300k. But because I have a deal with Wes, I get it for 250k. Wes is not happy because he has lost 50k based on market value. So this is the scenario that we'll be talking about in the whole derivatives course. This is what applies to forward, futures, options, and the rest. So this is what we spoke about in our forward class. Then we spoke about the underlines, bond, and the rest. I'll just rush through that. Then we spoke about exchange traded and over the counter. And we said over the counter is the same as the forward contract, while exchange traded is the same as a futures contract. And what does that mean? Over the counter says this deal I've said now between me and Wes is over the counter. Because I can tell Wes I want 250k and Wes will give it to me. But an exchange traded derivatives is now in markets. And of course, when you know that when there's a market for things, there has to be standardization, there has to be processes. Yes?
Quick one, please.
Okay. Go ahead.
So I know you mentioned forward. Forward futures, swaps, and options as type of securities. Like,
okay.
But I want to ask. I don't know. This question might sound fish. I just too much to ask. Does mutual funds classify as securities?
Mutual. So those are.
Does it qualify as securities?
You know, these are derivatives. So these are derivatives,
Yes,
and you know
yes,
they are deriving.
Does mutual fund does it qualify as derivatives?
Yes, we can say that because it is based on movement of different funds. You get so once those markets moves, this moves on top of it. So yes, you can say that. Are we good?
Maybe we can talk on it better later.
No problem. Okay. All right. So.
All right.
Thanks. So the exchange traded derivatives, like we said, is a market. So there is standardization, and because there is standardization, it comes at a cost because the people that will ensure that those standards are met need to be paid, and it also reduces the risk because this deal I've said between me and Wes. What happens in scenario 2 or scenario 3 where it's 300k and Wes says, "Chooks, I'm not doing again." What am I going to do? It's to be calling police. But Wes can say he's not doing again. But where there is a market, you cannot say you are not doing again because there has to be a trust, a system of trust in place. That's why you go to the market. You get it? So that's the idea. Okay, I believe that there is trust. Now that trust comes at a cost. So we spoke about exchange traded derivatives and we said, okay, because there is a market and there is a trust, you need to pay something. It's not like the one where the meeting I said between me and Wes is 250k. I didn't give Wes any money. We only had an agreement. But for the exchange traded market, something has to be on the table. Because is that something on the table they can use to say, okay, this person defaulted, I can refund you to cover your liability or to cover your loss. So we spoke about that as well. Then we spoke about the differences between over the counter and exchange traded. That was very important because it will always come out. So, but it's like I said, when you look at one as a market and you look at the other as just individual transactions, you will get to see what the differences are. For the markets, let me just run through that. For the exchange traded ones, you see that, like we said, traded at the centralized location and exchange. Location does not mean it has to be a physical location. But there is a market, there is an exchange. Traded by exchange members who are called market makers based on standardized contracts. So this standardized contract means that, you know, I wanted 250. It's possible that in the market they don't have 250. They only have 200 to 300. So I have to find how I'm going to balance myself. You get? Because I cannot get the 250 I want. So it's not customized, it's standardized. And have lower trading costs. subject to trading rules, of course, because it's regulated, backed by the clearinghouse. So this clearinghouse, like I said, these are the people that ensure that we minimize counterparty credit risk. Counterparty credit risk is also called default risk. It means that the other person will default. My transaction with West here can easily default. In fact, I don't even see West again. They will block me on all platforms. That's default risk. My money is gone. But when I go into an exchange, I know that I don't even need to know the person I'm dealing with. I'm dealing with the exchange. So it's the exchange that will give me what I need. So if the exchange does not need to tell me, oh, the person that was actually going to give you this thing has run away, it's not my business. I'm here, I came to the exchange to do a transaction. Anything other than that is your business. Give me my money after transaction is done. That's basically so that's what you mean by that. It's more liquid. It's more liquid because, of course, different people are coming. So there's a lot of volatility, a lot of movements, a lot of money moving around. Then it's more transparent, like we've said. Because they have regulators, they have to be open with their goals. Okay? Over the counter, which is the one-on-one, is custom instrument. Custom means I can customize what I want. Like this 250K, I can get to 50K. Less liquid, less transparent, subject to counterparty risks, difficult to settle, higher trading costs. So basically, so we spoke about those two. Then we went further and we said, okay, let's look at these forward contracts and future contracts. We now spoke about these future contracts, which is basically the exchange traded market. We said, okay, yes, we know that you need to put some money down at the beginning. So we said, okay, what are those things? So we said there's what we call initial margin. So initial margin is if I'm coming into a transaction with this exchange traded derivatives, I need to bring in some money first before anything starts. That's what's called initial margin. So it's more like a collateral, which is that if I say I'm not doing again, they will use that money to cover the risk of the other party. Remember that their job is to minimize counterparty risk. And how do they do that? Because they collected money. So they collect from me, the buyer, they collect from you, the seller, so that none of us can run away. Just like minimum account balance is there. Do they still have minimum account balance? In banks, in your accounts. Do they monitor it? The normal savings account, they still have minimum. So you can wipe it to 0.00. Wow. They're now taking our money from different small charges. So they are fine. So this initial margin, which is the money you must keep in your account. Now you now have what you call maintenance margin. So as the word says, maintenance, you must maintain. So this is the one. So this is the one that's the minimum balance. You must maintain this in your account at every point. That's what maintenance margin. So what that means is at the end of the day, transactions are going on every day. One person is, like we have done this now. At every point, one person is gaining, one person is losing, one person is gaining, one person. So it doesn't move from 250 to 180K straight. To move maybe 250 to 240, 240, 235. So for every line, buyer is gaining, seller is losing. Seller is gaining, buyer is losing. So it keeps fluctuating that way. So this people's job is to ensure that whatever way it fluctuates, there is no significant risk to anybody. That's their job. So how do they maintain that? They also ensure that if your balance drops below the maintenance margin, which is like the minimum balance at any point, they will tell you that you need to top up. And you need to top up to your initial margin, not your minimum balance. So let's say your minimum balance is 500. You add 600, you are fine, they will leave you. The next trading day, your money goes to 400. 400 is less than the minimum balance you're supposed to have of 500. We will now tell you, it's not just, we don't just need that 100 to take you to minimum balance. We need it to go above the minimum balance, which is the initial margin. So let me run through this example. So that's the idea. So we need to note that as well. So for this example now. So consider a contract for 100 ounces of gold. So the contract size, which is the quantity, is 100, right? To be settled on May 15, which is the future date. The initial margin is 5,000 and the maintenance margin is 4,007. So meaning the minimum you must have in your account is 4,007. Now, day one, the trading is 1,950 per ounce. That's the price. And both parties have been told to drop 5,000 naira each, $5,000 each, which is the initial margin, right? Now, day one, the price has moved from 1,950 to 1,947. Price has dropped. Of course, somebody has gained, somebody has lost. So the seller has gained 250, right? Because if he goes to the market price has dropped. So the contract he has agreed is worth more now, has more value. So he has gained. As he has gained, the buyer has lost, because now the buyer has put himself in a deal that costs more than going to the market to just pick up the product. Or let's just put it that way. So that's day one, blah blah blah. So that 250k will be added to the seller, which now becomes 5,250. That same 250 will be deducted from the buyer. 5,000 minus 250 is 4,750. Now their new balances are now 550 and 4,750. 4,750 is still higher than the minimum account balance, which is the maintenance margin. So no problem, nobody will get any call. We call it margin call. But day two, it falls again. It falls to 1,945. So there is an extra 250 again. Now the seller had 5,250. Another 250 on top takes it to 5,500. He's gaining. The buyer had 4,750. If you take out 250, it goes to 4,500. 4,500 is less than that minimum balance of 4,700. So what they will ask him to do is to bring 500, because 500 is what will take him back to 5,000, not 4,700. You get? And then it keeps going like that on a daily basis. So that's how when day 2 comes, day 3 comes, it happens like that. So we spoke about that last week. Then we spoke about so we said price limits, because at the end of the day, you know, this one we are saying 250. If it is 250 million, it's not easy for you to call somebody to drop 250 million. The person will not pick your call. So what the market does is it has what we call a price limit. There's a limit to how much trade and settlement they can do. Because for example, that 4,750 cannot just drop to 100 naira. You get? It means the call you have to call the person, it's not a lot of money. So they have price limits. In fact, some of the market puts ban on some trades. There are some trades you can't do because the price is too high. So they want to cover their risk. So that's what we call price limits. Then we spoke about swap. So swap, like I said, is basically just moving from one interest type to another interest type. If you move from fixed to floating or floating to fixed. Then credit default swap as well is also to we are owing something. You transfer that what you are owing to someone else, basically. So swaps is not so. So the main one is now option. So we said there are two types of options, basically. We said there's a put option and a call option. And I explained that the call is an option to buy. The put is an option to sell. So this way it starts getting interesting. So let's take it back to our discussion here. Myself and West, where I said I was going to buy laptop at 250. Now, let's assume scenario 2 is now the reality. We said this was happening in March. That's what you guys are right. So we said this was happening in March. And but the transaction itself will take place in June. It's fine, it doesn't take long. Okay, so we now said at this point now, I approach. So this is a transaction between Choose and West, and the buyer West is the seller. Listen, oh, so that when I ask questions, I'm not here take it again. So I've agreed to buy a laptop. Let's just assume it's a laptop. But of course, we know this is a durability. Laptop is an underline. Alright, so I want to buy laptop from West. We agreed in March that I will buy it at 250k. We are in June now, the cost of the laptop is 180k. Between 280 and 180, who has gained, who has lost? So far.
The buyer has gained, the seller has lost.
Do we agree?
I said the buyer has gained, the seller has lost.
The buyer has gained, the seller has lost. Okay, that's one answer. Any other contradictory answer, we all agree with him. Do we all agree? Samuel? Yes. You agree with him? Wes, you two agree? CEO, do you agree? CEO and Emmanuel, I didn't hear anything. So you said, let me write what you said so that I'll be sure that you see buyer gain, I mean, seller loss. I mean, this is what people say. Alright, so let's prove it now. I agreed in March to buy something at 250,000. Okay. That laptop that I agreed to buy at 250,000 in the market today it costs 180,000. And you people say buyer has gained. How has buyer gained? Now I'm happy to buy something that is worth 180k. I'm happy to buy it for 250k. And none of you say you are agreeing. Samuel, don't say you are the one that led them astray.
I didn't hear the question very well.
Oh, you didn't hear the question, and everybody followed you. So
I didn't know that was said.
So you answered your own question. You set question for yourself and you give answer. Okay. So because the price in the market is 180k, but I've agreed to buy that same product at 250k. Me as a buyer, I'm losing. Because if I did not have this agreement to buy at 250k, I'll just go and buy it at 180k now. Do you understand? That's how you know. Yes, I understand. You'll get the question now. I'm here at the last second. Now, in this case, buyer has lost. Let's take it to 300k. In the case of 300k, the product is, I can buy the product, if I go to the market, it costs 300k. But I have agreed to buy it at 250. Me, I have gained as a buyer. Because if I didn't have that agreement, I'll be spending 50k more than I want to spend. Okay, so let's take this scenario 2 now. Let me bring in options. Because this one now, we have assumed that I can't walk out of this deal. I'm not happy about it. So we are taking the 180k scenario. 180k. So this 180k, I'm not happy about it. But I have an agreement with West to buy at 250k. So I have to honor that agreement. Let's assume I'm investing on the integrity and this business is going to happen. Remember, one of the issues with forward and over the counter is that I can say, 251, I don't know, the difference is too much. But, you know, I'll block West and I'll not pick the spot. But that deal will not happen. But there's something called options. As the word says, it gives me an option. It gives me a way out of this predicament. That's what option is. So, as a buyer, which is being choose, normally I would have lost here. Normally I would have lost here. But because there's an options on the table, what does that mean? It means options now gives me, so option is a right, but not an obligation. What does it mean? It means that the right means I have the chance to take it or not take it. Obligation is something that you are forced to do. Do you understand? So it's an option, I'm not forced to do it. So I only take it when it benefits me. When it doesn't benefit me, I leave it alone. Right? So I now get 250 minus 180 is what? So I'm looking at that. This is how I'm going to lose 70k like this. This thing doesn't pay you. Where does options come in? So options now says, so first of all, options happens before. So this option, I would have bought it in March. It's not in June, I would not say I'm looking for it. No. It's in March when I'm doing the transaction with West. I will do the transaction with West, but now add a layer of option on it. So what does option say? I'm the buyer, right? So meaning I'm going to buy a call option. Remember I said call gives me the option to buy something. So because I know I'm going to buy something from West, I will now go and buy a call option and say, okay, what does that option mean? That option is, let me write it down. That option says, if the price, remember I'm in March, this option is in March. I don't know what's going to happen in June, right? So let's forget this scenario. This scenario we're looking into in future. Let's go back to March. I said I'm going to buy something from West, right? At 250k. And that's okay. So that 250k we have agreed is what we call exercise price or strike price. Right? It's just a name. It's the same 250k we spoke about before. It's just that the name is just different. So the first question is option 1. So let's look at these three scenarios now, right? That we said are likely to happen. So scenario 1, if the price is 250k, do I need an option there? I don't need an option because I'm not losing, I'm not gaining, right? So this one, no option. Scenario 2. Scenario 2 is what? If the price is 180k. As a buyer, am I gaining in this 180k or I'm losing? I'm losing, right? So do I need a way out here? Good. So I need an option here, which we will now discuss. So I need a bailout here. Scenario 3, the price has gone to 300k. Do I need an option here? No, because he paid me to go ahead with my contract, so no option. So basically, the only place I need option is where I'm losing, right? So even if I had an option before and scenario 1 happens, I will let the option go ahead. Scenario 3 happens, I will let the option go ahead. But for scenario 2, I have to decide. So what the question is, what are my options? So I will now say, okay, if the price is less than, because I don't know that to be 180k, all I know is that if it's less than 250k, I am losing. So I will go into an option to say, if the current price is less than 250k, so this option is going to be my way out. I will walk out. You know, there I couldn't walk out. But if this option, if I notice that the price is 250k, I'll walk out. So bring this option back to this place. So if I discover that, oh guys, scenario 2, I'll just walk out. West will not call me, I'll not call West. We have a good transaction. But the question is, if I walk out, what has West gained? So West has just lost 3 months. You get what I'm saying? So for me to get this option, there's a cost. There's a premium to it. So I'm going to buy this option and I will buy it at a price of maybe 50k. Let's just assume 50k, right? So if I buy this option for 50k, it means that in March, I will now give West 50,000 to hold. That okay, I'm buying this option for 50,000. Do you understand? So that's this. Now remember in this first scenario, I will just bear the loss of 70k and move on. But now, I have an option to say, okay, I've given, can be Wesley, can be someone, can be Samuel. You are the option writer. So this option is different from the original transaction. So I said I give 50k today. So it's okay. If this price drops to less than 250k, you will bail me out of this situation. So let's have a look at it. So let's say we now realize that it's 180k, right? 250 minus 180. We have said the 70, right? So if I honor the contract with West, I will lose 70, right? Right? But if I trigger my option, I will only lose 50k. Which is that 50k I gave you in March. Do you understand? So next, what am I doing? I'm only losing 20. Sorry. Nah. That's two different things. I will take from the other side. So I'm losing 70. If I had gone into this transaction, right? If I had gone into this transaction, I would have lost 70k. But because I'm not going into this transaction and I'm activating my option, now I'm only losing 50k versus the 70k I would have lost. So in this case, it's a gain to me. I'm gaining 20k because of this option I have brought up. Do you understand?
Can I quickly ask a question?
Say that again.
I said, can I ask a question?
Yes, please.
Okay, so if the person bought the option and he deposited 50k, right? And at the end of the maturity, and he wants to pay for he's not exercising the option, like he wants to pay the 250. The person will be paying the balance, not the whole 250, right? He will be paying the 200.
No. You will be paying the 250. 50k is there. 50k is the premium.
So that means invariably the person has paid the 200 total.
Exactly. So we'll get to an example of that.
That means what the person is losing is not 70 then.
We'll get to an example down. Don't worry, I'll show you.
Alright.
Okay. So let's just second go there. Because I'm taking us to today's class. Okay, continue.
So why am I as a buyer? If you keep accept as buyer, what am I giving you?
We are giving it to the writer, the person you are buying the options from. So in this scenario between me and you now, I'm buying laptop from you. But I now go to, for example, I now go to Samuel to say, Samuel, I want to buy an option. So that 50k I'm giving Samuel as the option.
So in June, laptop is 180. Well,
the laptop is 180 in the market, meaning that I'm not going to buy it from you, right? So I will exercise my option with Samuel. Meaning that
from you to collect 50%.
no, I can't. That 50k is gone.
So
The 50. Okay, let's go to an example.
no, I'm okay with you. I don't want to obviously where we are.
So that 50k is gone. It's like I'm putting money down for something. I'm not getting that 50k back.
Okay.
But that 50k is giving me a way out. To not, yes, I don't have to buy that laptop again.
And I don't have to know about your.
And so in some scenarios, we assume that I even got the option from you. So the idea is I bought the option from you. Okay, let's make it easy. I bought the option from you. So if I did not, because now I have an option.
We need to pay.
Bam. So your own benefit as the seller is that 50k. So I'm not buying laptop again. But you have that 50 exactly. Instead of a scenario where I just walk out, I don't give you any money, I just don't do the deal again. Okay, let me go to the example so that we can relate a bit. Okay. Okay. So now, so no, options the one way. That's me. I can't come back and collect my 15. Yeah. So there are only two things that will happen between me and you in that example. Either I come and buy laptop, or I don't buy laptop. If I come and buy laptop, 50k is gone. If I don't come and buy laptop, 50k is gone. You get? So why I'm putting that 50k is so that, because I believe that the price may go up higher than that 50k. Like this our example. If I come to buy the laptop without an option, I'll be losing 70k. But now that I have an option, I'll not buy laptop from you, I'll just leave you. I will only lose 50k I gave you initially. Exactly. So to me, it's like I've gained 20 because of that option to walk away from a deal that was not working for me. You get it? Okay. Those are actually coming to you, we'll still explain your answer. So, if the exercise price, let me use an example with, sorry. Yes, good. So guys, let's pay attention now. Right? So, call option profit and loss. So this is what I was trying to explain before, seller buyer. So consider a call option. A call option is an option to buy with a premium of $5. So this premium is that 50k I told you about. So this $5 is gone. As a buyer, I'm paying you $5. I'm giving you $5 already. Right? So this is the cost of that option. That's what we call the option premium. Consider a call with premium of $5 and the exercise price is $50. Exercise price is the price we have agreed today. So this $50 is our 250k. Right? Now, this means the buyer pays $5 to the writer. The writer is the writer of the option. The person that is giving me that option right. At expiration, which is June, if the price of the stock is less than or equal to $50, the option has zero value. First of all, let me stop here. I am buying an option. Now, if the price of the stock is less than or equal, let's say less than, let's say the price is 48 and we agreed 50. As a buyer, am I gaining or am I losing? It's not for anything, no. Anything. It's not stop or no stop. The examples will make the same. I have agreed to buy something at $50. $50 is exercise, which is the price I've agreed. Now the price today is now $48. As a buyer, am I gaining or am I losing? I'm losing. Guys, this is the foundation. No? This one need to be answering it pa. Now, I'm losing here, right? Meaning I need a way out. Meaning I need an option. Now, in this case, which is what it says, if the price of the stock is less than or equal to $50, which I've demonstrated here as material, the option has zero value. Meaning you are not gaining with that option. The buyer of the option is out $5. Meaning the buyer will just say, I'm not doing it again. Let me go and buy from the market. But that $5 I've dropped, put it low. That's what it means that the buyer is out of $5. Now, the writer of the option is ahead of $5. So the person I told I wanted to get an option, right? He has gained $5. I have lost $5. Right? When the stock price exceeds $50, this is the other way now. The option starts to gain. Right? So Tosi, I'm getting to your point now. So we have said $5 is the premium, have you? And this money has gone, whichever direction it is. The money is not coming back to me. Now, if the price has moved from $50 to $55, I will now say, okay, I want to exercise the option. Are you following me? What is the option? Remember, the option is I will buy it at $50. And that's okay, yes, he paid me 55 outside, it's more expensive than 50. So I will buy at $50. So I will spend $50 to buy, that's the original money I was supposed to spend. Plus $5 I paid to the writer. I'm not getting that money back. Plus $5. So this is $55 that I'm spending in this scenario. So I did not lose, I did not gain. That's what it is saying here. When the stock price exceeds $50, the option starts to gain. So the gain in the option is this 55 minus 50. Right? So there's a benefit of that transaction I went ahead to do. There's a $5 benefit of going ahead with what I agreed. When the value of the stock equals the exercise price, okay, break even will come at 50. Conversely, as the price moves upward, the seller of the option starts to lose. Negative figures will start at 55 when the value of the stock equals. Okay. So this is another scenario, 55. So let's take it a step higher. Let's take it to 58 for argument's sake. If the price of the stock, Samuel, you are not with me today. If the price of the stock, Samuel, you are not with me. If the price of the stock in the market is $58 and I'm going to buy it at $50, will I go ahead? Yes. So what is my benefit here? I have gained what? $8. But because I'm already into an option, in this case, I'm not going to use the option again because this transaction pays me. But there's a cost to that option, which is what? $5. So net, my gain is $3. If I had not done this option, I would have gained $8. But I did this option because I know that there is a risk that the price will drop. So I'm trying to hedge my risk with this option. So this cost of this option is not going anywhere. You will pay. Either you lose only that because you are not going ahead with the original transaction, or you lose it the other way. You must not lose it. Tosin, do you understand now?
Yes, I understand, but you didn't explain the part if it is less than, if it is less than 55 or greater than 50.
Oh, good. Good question. So let's pick 52. It's the same thing. Now, if it's 52, how much are we getting? $2. So $2 minus your $5 is what? $3. So you are losing $3. You cannot say because this 2 is not greater than 5. This 5 is already lost. There is nothing you can do about this 5. This 5 is already lost. And you cannot say because I put 5 somewhere, therefore I will not honor this agreement. Meaning you still go outside of the market to buy it at 52, which is more than 50. So you will still do, as far as, we'll go to the formula, as far as your this thing is less than $3. So it pays you that, okay, let me not even exercise the option. Yeah, so in this case, hold on, let me go. There's a formula that I'm going to show now. Max of this minus this. So in this case, really, so because it's an option, you now have to look at it. Does it pay me to go ahead with this or not to go ahead with this? So you have to weigh. That's why it's an option. You have to ensure that you're not losing in an option. So in this case now, at the end of the day, for this one, you won't exercise because it pays you to just go at 0. Meaning you are not doing it again. Okay? So let me show you. Just give me a minute.
Sorry, Mr. Chicks, I didn't get what you said. Did you say for that 52, it pays you not to do it?
Yes, it pays you not to do it. Because, let me show you a formula. Because as an option holder,
I don't think so.
Hold on. Yes, so this is the formula I was looking for. Because as an option holder, you are not going to lose. So I will answer your question with this. Unlike forward futures and swap options are sold at a price, they do not have zero value at initiation. The price of the option is also referred to as option premium, which we have said. At expiration of the payoff of a call option to the owner, the value of the call option is a maximum of 0 or the value minus this, underlying value minus the exercise price. So what that means is, so you see this now, that 2 minus 5 that will give you minus 8, it will not exist. Because remember, an option is to give me a way out. So I'm not going to go into an option that will give me negative value. So this says where S is the price of underlying, which I said, and X is the price of the option. The maximum function tells us that if S is less than X at expiration, the option value is 0. That is, it expires worthless and will not be exercised. At expiration, the payoff value of it, let's see. So we are still going to the top. So what this is saying is our formula of the maximum of 0, S is the underlying price, which is 180. 180 minus 250. This is minus. So this one cannot work. So it means that we will not exercise. We will not exercise. But if it is higher, if it is 290 minus 250, we will exercise it. So this is the original one. Now where Tosin is now taking us to is, okay, yes, he's not exercising this one, right? But he has put in $50. I'll be $5. So this $5 is a loss that will always exist. So this is the maximum money he's losing. He cannot lose more than this. You get? He cannot lose more than this. So if I had like this other scenario we did here, if this one is positive, meaning yes, it's going to go ahead with the option. This is 40. But it still has that $5. So you take out that $5. So it's possible that at the end of the day, he's gaining here, but because of that $5 he has contributed, this can be a loss. But in the option itself, you have to have a positive or 0. You cannot lose with an option. It's just that option premium that is like dash money. There's nothing you can do about that. Tosi, are we good?
Mr. Chicks, I'm not sure we are good.
Ah, okay. Oh yeah, ask the question.
I'm expecting to hear that.
Ah,
Wait.
okay. Let me look for an example.
Like this. If the price is 255,
Let's look at this example. Let's look at this example.
okay, what you look at next?
Yes. So let's look at this example and let's see if this has, because this one has everything. This one has a premium, right? So let's look at this one. Okay. So this one is like a combination of different questions. But let's look at the core parts, right? So suppose that both a call option and a put option has been written on a stock with an exercise price of $40, right? The current price is 42, and the call and put premiums are 3 and 0.75. So I will do the call. Okay, I've not done puts, so we'll do it together. So it's a call option, which is an option to buy, right? The exercise price is $40. which is X. And what did we say? This is the price at which I want to buy. Have it? Now, the current price today is 42. Don't worry about this. We don't need today's price. It's future price. So they now told us the call premium is $3. It means for this call option, I have paid $3 already. This $3 we said is what? OT law. It's not coming back to me. It has gone. Now, calculate the profits. Long, short, I've explained that one, but let me just see this other point. And the call, okay. For both the root and call with an expiry date, so the stock price is $35. So F is $35. So we are giving two options: calculate at 35 and calculate at 43. So let's take it one by one. Now, we agreed to buy something at $40. That's this what we want to buy now costs $35. Is the buyer gaining? Is the seller gaining? What is happening here?
I said yes.
Okay. So yeah, the buyer is losing because what he can get at $35 is getting at $40. So we calculate this option for the buyer. So this option now, we're now looking at for this call option, we're now looking at that's the long and the short. The long is the person buying the option. The short is the person selling the option. So the person that bought this option, which is, so now you have $40 minus $35, which is minus 5, right? So is he going to exercise this option or not? He's not going to exercise the option, right? So meaning the option, you allow the option to expire to 0. But his total value, he would have lost $3. $3 plus 0, which is $3. He would have lost this money because it's the money he has already paid to get this option. So as a buyer of this option, you will lose $3. Now because you have gained $3, the person that sold this option to you, that he did not come back again, would have gained what? He would have gained this $3 that you lost, right? So that's the net. Now, let's use the second example of 43. So 40 and then 43. Now, is he going to exercise this option or not? He will exercise this option, meaning that 43 minus 40, which is what? 3. This is the gain on this transaction, but there is still a 3 that he has paid. So 3 minus 3 gives him 0. So in terms of the value of this option, he has not gained anything as the buyer. The seller has that 3 in his hand, but he has lost 3 as a result of this. When he goes to the market, he would have gotten 3. So 3 minus 3 is 0. So in this case, they are both not gaining. In this case, it's gaining 3, it's gaining 3. It's losing 3, it's gaining 3. So you see, at the end of the day, the buyer can still lose, but he's not losing because of the option. He's losing because of the premium he has put. So this buyer cannot lose more than $3. Even though we see that it has dropped by $5, price has dropped by $5. But he can only lose the maximum he has put down as premium. Do you understand? Tosin. Okay.
Yes, I do.
Okay. Does this answer your question?
Yes, it does.
Your yes is not convincing. Okay. So the one I've explained is So this is the call. The long, so long and short. You see long and short. Long is the person buying the call option. Short is the person selling the call option. So you need to note that. So which is what I've explained there. Now the buyer of the call option, which is this -3 now, the option has no value to him. The option doesn't have the value to him because looking at the option alone is -5. And remember, he cannot lose in the option. Right? So because it's -5, it means it is 0. That's it, 0. But he has paid a premium of $3. That's why we said the buyer loses the premium paid. And of course, the seller of that call will only gain the premium. Let's leave put. I'll come back to put. So if we go back to the 43 option, which is this long call, which is the buyer of the call. He paid $3 for the option. And now the option has gained $3. But because of that $3 he paid, his net is what? 0. So going back to Tosin's example, if because here he gained $3, if here he only gained $2 and the premium he paid was $3, it means here he has lost $1. You get? I'm sure that's where Tosin's question will come from. It means here he has lost $1. But he did not lose from the option. He lost because the benefit of the option was not enough to cover the option premium. So he cannot lose more than that $3. You can only lose less than. You cannot lose more than the premium. You can only lose less than the premium. The premium is the maximum value you can do. I think I'll go back to this guy. Okay, so that's for call. So let's flip it now. I want you guys to do the put option. So do you understand? I hope your yes is stronger now. So
Yes,
guys,
I understand.
okay, good. So do the put option in your notes. Let me see. Remember first, the put option is the opposite of the call option. Right? So the call is the option to buy, the put is the option to sell. So first question is, if the price is specified and is a put option, what is going to happen? Same way I've done my own calculation. Oh yeah, open your note. So you are doing puts for 35 and 43. And you are doing the two parties. The person that bought the put option and the person that sold the put option. So let me explain again. The long puts. So you are doing long. You are doing long and short. Buy, sell. So you can have a long call, which is what we are saying. A long call is somebody that is buying a call option, right? The call option in itself is an option to buy, right? So I am buying an option to buy. Forgive me with the English. So let's now look at what is a long put. A put option is an option to sell. A long put is an option to buy, an option to sell. Do you understand? So I'm a seller. I want to sell something, but I need an option to be able to sell that. So that's what you call long puts. So the one I did for you guys was I did this and I did this. This one was that you are buying the call option, right? So does it pay me from a buyer's perspective? This side will say from a buyer's perspective, did I gain or did I lose? This one will say, okay, I sold the option to the person, so I had the premium with me already. So did I gain versus the premium I have, or did I lose? It's the same way we are going to do it for a put option. So let's go. You have 5 minutes. So you are doing for $35 and $3 put option. Let's go. You think so? Okay. Tosin, do we have our answer? So your answer is supposed to be 40, so you're supposed to give me 4 answers. See. So, toss the alpha. You're supposed to give me long quotes. You're supposed to give me.
I can't even see the code very well.
Since morning, you did not complain about seeing the board, though. Alright, so there is the long quote. This long quote, you will tell me buyer and seller. Sorry. For the $35, pay me buyer and seller. For the $43, tell me buyer and seller. Wait, so you walk me through your answer. Explain your answer to me.
For 35,
Okay?
the seller gains 5%. 5, the seller gains 5%.
Okay, so you are adding 0.75 to me. Okay?
And the buyer loses 0%.
So the buyer of the put option has paid 0.75 as premium, right? And he bought an option to be able to sell at a price. So now he has said that he wants to sell, he has agreed to sell at $40. But now the price in the market is $35. So you go ahead with the option. We don't sell at the 5. So he's gaining 5. But because he has a cost of 0.75, so 5 minus 0.75. Okay? Tosi, are you ready for me? You are ready. Okay? Now the seller.
Let me check.
Oh yeah. Your own, you are giving me 43. Oh yeah.
For 43.
Yes.
Okay, so for the put option at 43, why the exercise price is at why the exercise price is at 40? So the what do you call it?
The buyer.
The seller will not exercise the option. No, is it
The buyer.
the buyer?
Yeah.
The buyer will not exercise the option, meaning that it's going to buy at 40 because the expiration price is greater than the exercise price, which is the difference of $3.
No. The buyer is the buyer of the option. Remember, he has bought the right to sell. He's not the buyer of the stock. Do you understand? So you were right up until the last point. So you were right when you said the market price is 43, which is the price at expiration. The exercise price is 40. I have agreed to sell at 40, but now in the market they are selling it at 43. So I will not exercise the option. You are right up to that point. Now the buyer of that right not to sell or to sell will now say, okay, because I'm not going to exercise this option, but I've already paid somebody 0.75 as a cost to give me this right to decide to sell or not to sell. So the only thing he's going to lose will be that 0.75. But he's gaining $3, 43 minus 40. So 3 minus the 0.75 is the 2.25. So his net value is 2.25 as the buyer. Do you understand? Because that way you are going to buy one stock.
Okay, I understand. Yeah, I understand.
Okay. So that's let's look at our answer whether we are not correct. Are you correct? Stock at 43. So you see we are not even correct. So the long put, this is the one. So this also answers that your question. So this one says 40 and 43, right? So this 40 and 43 means that he's not going to exercise the option, which gives him the 0. Right? So he's not exercising the option, which gives him the 0. But because he has paid 0.75, meaning that his value is is losing value. So he's only going to lose minus 0.75. So scratch what I said before about this one, because we are taking it a step further, where we are now saying that if it goes to the market to sell, we gain $3. So
no, this is what you said now.
Yes, but I added the $3. So take out the $3. What we are looking at here is, did he exercise the option? No. If he did not exercise the option, which is $0, and then the cost of the put option, which is 0.75, that's the only thing he's going to lose. So the maximum the buyer is going to lose is 0.75. I just took it a step further to say, okay, yes, he has lost 0.75, but now he can go to the market and sell at $43 and gain $3. That one is outside of this scope. So when you are stopping there is, what are you gaining from the option, and then what have you paid as the option premium? Those are the two things we are looking at, right?
Yes.
Okay. We've explained this one as well. We've explained this. Okay. So is it clear? Is it clear, or should we take it again? Wes, is it clear? Okay. So just to summarize, is you ask yourself the question first of all. So there's what we call in the money, out of the money, and at the money. What does that mean? When we look at the exercise price, so for the call option, the person that is buying, he agreed to buy at $40, and now the market is selling at 35. So the buyer is losing in this case. So meaning this option, he will not exercise it, and we call this option out of the money, because looking at the option alone without the premium, he is losing $5 in this case. So this option is out of the money, he will not take it. If it was 40-40, then it is at the money, he's not losing, he's not gaining. But if this price was 43-45, it means he is in the money, he is gaining money. So that's that. I just wanted to point that out. In, out, and out of the money. So after that, the other thing is whether you are gaining. So you see that in all this calculation we are doing, we'll first look at exercise price versus the price of the stock or whatever. Whatever we get there cannot be less than 0. Right? Is either greater than 0 or 0. Because once it is 0, it means that it doesn't pay us, so we are not exercising it. But once it pays us, we will exercise it. So that's step 1, identifying whether your option is in, at, or out of the money. Meaning, if it's in the money, then you have a positive. If it's at the money, it's 0. If it's out of the money, it is 0 as well for you. After identifying that, which is step 1, you now go to step 2. Step 2 is, okay, a premium has been paid. The person that bought the option has a cost of the premium. The person that sold the option has a profit of the premium. So you now add what you have gotten from step 1. So step 1 was this 0. Okay, 0 minus the premium I have paid. That's the buyer. For the seller, 0 plus the premium I have. So that's what you do at the end of the day to get the balance. Okay. All right. So this one is just a simple contrasts forward commitment and contingent liabilities. So for contingent liabilities, as the word is contingent on something, meaning something must happen for it to happen. That's what it means by contingent claim. And then you have forward commitment, which is just a binding promise. Okay, let me see. All right, let's answer number 5. No, let's do 3, 4, 5. But I'm more interested in 5. So option 3, option 4, and question 3, question 4, number 5, question 5. Please answer it in your notes. So you're answering 3, 4, and 5. So 3 A, C, A. You get it? Summer. So we have explained derivatives, looked at options and all. We looked at the value of the option and all those things. We'll still look further into them. So here is now saying what are the benefits of derivatives, what are the risks, who are those that issue it, and investors as well. So remember we said that derivative is deriving its value for something from something else. It's not like you're investing in the item itself. You are just investing in something that is getting its value from the item. So that's what the derivative instrument offers several potential advantages over cash market transactions. One is ability to change risk allocation, ability to transfer risk and manage risk. We've already mentioned benefits from the beginning, but let me just run through it. So some examples of ways that risk exposures can be altered using derivatives without any cash market security transactions are: 1. A portfolio manager can increase or decrease exposure to the risk and return of the market index. So we know what market index is. So based on this, you are not investing on the asset itself, or in a case where you have combinations of companies coming together, like the FTSE 500 and all those markets. You are not investing in one company, you are investing in a combination of companies coming together, but which is that derivative. But how those companies move would affect your movement in your asset portfolio. So, but because you now have a portfolio of assets and you are not just investing in one asset, you can manage your risk in terms of balancing it out. You can say, okay, I want more of this particular share, I want less of this one, because I see that the risk of one is rising and the other one is going down. So you can just balance it. So you can balance it out. So that's what it means here by the portfolio manager. So for things like your pension fund and the rest, they are invested in mutual funds, trust funds, and all those things. So those are ways they can measure reduce or increase their exposure to risk, because you are using people's pension. So the idea is you can't be too risky with it. In fact, you should even be risk averse, because you have a lot of money. So a 2% on a 5 billion is different from a 10% on a 5 million. Very different. So your risk appetite when you are holding huge set of funds has to be a lot lower. Okay. Number 2, manufacturer can hedge exchange rate risk of anticipated receipts of payment. This is the one we have been using as an example. That if you know you are going to buy something from somebody from another country, and you know that exchange rate can affect you, you can use derivative to hedge that risk. In the last one, an issuer of floating rate notes can change exposure to fixed rate. So this is the swap I spoke about. If you are paying, if I have a loan from Samuel now, and the loan I'm supposed to pay 60%, every month, I can go for a swap option where the interest rate will be fluctuating. Maybe the interest rate will be mapped to a reference rate. So this month 5%, next month 7%, this month 4%. So I believe that one I can use that to hedge this 6%, and so that's what it means. I can swap that exposure. So instead of me handling that exposure, I pass that exposure on to someone else. Then I'll be paying the floating rate because I believe maybe that the floating rate will be going down compared to the 6%. That kind of thing. Okay, derivative instruments can be used to create risk exposures that are not available in cash markets. Consider the following examples of existing risk profiles. I don't want to bore you with all these things, but it's just we don't really need it. Okay. So information discovery, derivative prices and trading information that cash markets do not. So what it's trying to say is that there are a lot of things you can do in derivative that you cannot do with the actual cash. So you can say you want to buy a stock, for example, buy and sell a stock, but that stock is not moving. But you can have a derivative on that stock, and that derivative you can be trading on it. The stock remains there, you are not moving the stock, but your derivative can be moving because your derivative is linked to the stock. So that's that. Option prices depend on many things that we can observe: interest rates, price of underlying, and the rest. Futures and forward can be used to estimate expected prices of the underlying assets. So as derivatives are as well, because of the way derivatives move and the way people are moving, you can use that to estimate what the actual stock price will be. So people are moving in this direction, so maybe people are likely to sell because of the kind of contracts you are seeing for the future. So you can use that to estimate exactly what is going to happen to the underlying assets. Interest rate futures can be used to infer, same as that. I don't want to waste too much time on this. Operational advantages. Ease of short sales. So taking a short position in an asset by selling a forward or a futures contract will be easy to do. This is what I just explained. Difficulty in borrowing an asset and restrictions on short sales may make short positions in underlying assets problematic or more expensive. This is what I said. So instead of, maybe it is that laptop that we use as an example now. Instead of us trading on the laptop, we can trade on a derivative that is based on that laptop. The derivative will move faster because we are not moving laptop up and down. That's what this is saying. So the ease of short sales. Meaning, I can sell now and buy back within a short period of time and make that margin in between. That's what this is saying. So it's easier with derivatives. Lower transaction cost. It's believed that it has lower cost than normal posting. Because for the laptop, I have to transport the laptop, bring it to me, and I sell it back to you. That's cost that will not happen in the derivative market. Greater leverage, greater liquidity. Okay? Then you have the improved market efficiency in terms of the exchange traded markets that we said, where you have low transaction costs. So the exchange traded funds that we spoke about, that's what this is saying. Lower transaction costs, greater liquidity, leverage, blah blah blah. Risk of derivatives. So the risk of derivatives basically is in terms of one we spoke about the transparency. Transparency may not be. So for a derivative, you can sell a product that probably doesn't really exist. You get an underlying that doesn't exist and you hedge on top of it. Okay, so that's that. So then you have the low cash requirement, the investment. So then the transparency, I spoke about this transparency as well. Basis risk. So basis risk is the risk of the underlying of a derivative that differs from the position being hedged by them. What does that mean? It means that, which is also related to what I just said, the asset itself. There's a risk of the asset itself. It's different from the risk that the derivative is doing. Because like we said, the derivative can somehow be separated from the underlying. You are trying to detach yourself from what is happening with the underlying itself. Okay? So for a manager with a portfolio of 50 large cap US stock, selling a forward with the S&P 500 index as the underlying in an amount equal to portfolio value would hedge portfolio risk, but will not eliminate it because of the possibility that returns on the portfolio and returns on the index will differ from the life and forward. I don't want to stress you with the rest. But the idea is that sometimes what is happening with the underlying and what is happening with the derivatives are different. So that inherent risk with the derivative, you are not experiencing it with
Derivative. With the underlying, let's mention the derivative. Liquidity risk, we've spoken about this as well. Counterparty credit risk, we've spoken about this. Then systemic risk. Systemic risk is the risk that exist in the environment and the market you are in, regulation and all those things. Okay? So derivative uses by issuers. So you need to understand this one. There are people that issue the derivatives and there are investors on the derivatives, just like I said, there are buyers and sellers. So derivatives used by issuers. So corporate users of derivative instruments are considered issuers of derivative. A non-financial corporation may have risks associated with changes in asset and liability, as well as blah 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 blah. Some examples are: one, a corporation may have income in a foreign currency and hedge the exchange rate risk with forwards to smooth earnings reported in their domestic currency. So you have done a transaction with a company, but you want to be able to hedge that risk. So your foreign exchange risk exists, but you want to hedge that risk. So what this one is saying is you can hedge that risk and put it into a forward or a futures contract, and that will help you smoothing your earnings in your currency. So instead of the fluctuation of the exchange rates, you know you have come agreed a deal that will help you manage. So if you have said, okay, for the next 3 months, I'm going to do my FX transaction at 1,003 or 1,004. That is what is going to show you your books, because that's your exchange rate. But in reality, exchange rate is going, you know what's happening with exchange rate now? It goes to 16, 17, it comes down, black market has crashed. So there are things people are doing behind the scene. Whether it's sustainable or not is another question. Because is it the fundamentals that I'm looking at move like that? No. You get. So there are still fluctuations that will still happen. So this, one of the reasons why people use derivative is to hedge against that. Instead of having all those fluctuations, you know you have a balanced FX. Another is a corporation may use fair value reporting for its debt. So this one is just talking about interest rates. If you change, when you do a swap from floating to fixed interest rate, that would also affect your valuation. So all these are people that use derivatives. Basically, that's what they will ask you. Who are the people that use derivatives? They will not really ask you what it is they use it for. The main thing is to hedge risk, exchange risk. That's the most popular one. So same thing with inventory and all. So accounting rules will permit hedge accounting, allow firms to recognize gains and losses of derivatives. So we'll explain this at the cash flow. It's the same as those. Please, can you read? Oh, thank you. So it's the same as what you have on top, which I've spoken about, fair value rates. So you guys can take out time to read all this. I don't want to overbore you with this. Okay, now that is derivative used for the people that are issuing the derivatives. Now the people that are buying the derivatives, that want to invest in it, investors can hedge, modify, or increase their exposure to the risk of an underlying asset or interest rate with derivative positions. An investor can buy silver forwards to gain exposure to the price of silver with no or low funds initially required. So remember we said this now, derivatives makes it easy for you to enter a market. So if you want to buy gold now, you know how expensive it is for you to say you want to buy gold. But you can enter a derivatives market for gold at a much cheaper rate. Do you understand? So you are not buying the gold itself, but you are buying a derivative on that gold. So it gives you that ability to engage in markets as well, even if you don't have the funds. Okay, so let me just rush through that. So please take out time to read that. Okay, so I move to arbitrage opportunity. So I think I've explained this before. Arbitrage is a situation where we are saying that if I buy, for example, let me use, what can I do? So if I buy something in one market, let's just assume I buy something in one market and I transfer that same thing to another market. without any special cost. It means that I have made no arbitrage profit. I've made an arbitrage profit because I have moved. So there was a time the dollar and the pound, dollar, pound, and naira, the exchange rates were not exactly the same. What do I mean? So if I have naira and I buy dollars and I convert it to pounds and I change it back to naira, there's really no cost. Let's assume there's no cost for this transaction. Normally, if everything is equal, I should have the same naira, right? Because I've not done any business. I've just exchanged funds. But there was a time where the exchange rate was not balanced. So you could make money by that transaction. Taking naira, changing it to dollar, changing dollar to pounds, changing pounds back to naira. So the exchange rate between pound and naira was not aligning with the exchange rate between naira, dollar, and pounds, which should align. But because of the way the volatility was in the market. So of course, people that do all those things will make a lot of money. You have your naira, you change it to dollars, convert it to pounds. So if you have 1 million naira and you do that movement, it's possible that the naira that comes back to you when you change the pounds back to naira is 1,050,000. You have made a 50,000 naira profit by almost doing nothing. That's what you call an arbitrage. So what happens is in every area where arbitrage exists, there's always movement towards it to close that profit. So everybody realizes, this guy is making 50-50, everybody will flood into that market, then that opportunity will be cancelled, and then it goes back to put 1 million, that go, come back to 1 million. You get it? So that's what arbitrage is saying. So it says here that arbitrage refers to a transaction in which an investor purchases one asset or portfolio of assets at one price and simultaneously sells an asset that has the same future payoffs, regardless of future events, at a higher price, realizing a risk-free gain on the transaction. That's what it's saying. You are realizing a gain without any risk. So I have two assets. These two assets, in 3 months' time, they will give me the same benefit. But if I sell asset A and I sell asset B, two of them are supposed to give me the same, let's say 100 naira at the end of the day. But asset B is giving me 105, and they are similar assets with similar portfolios. What does it mean? Everybody will leave asset A, sell asset A, and go and buy asset B so that they can sell it again and make that arbitrage profit. But so as everybody is tilting towards asset B to sell it, the price will be coming down and it goes back to that 100 naira. That arbitrage opportunity closes. That's what this is. So the idea is, most times our discussion in derivatives or in economics or whatever we discuss, we believe that it's a no arbitrage condition, that you cannot make money by doing that. So for example, if someone gives me this phone now and sells this phone to me for 100k, I don't do anything special, and I sell this phone to you at 150k, I've made a 50k profit without any risk involved. And I tell somebody, in fact, as I sat down like this, Samuel is even the one that came to drop the phone about 100k. Somebody else walked and picked the phone 150k. I didn't do anything. Didn't add any value to it. I didn't do anything. So it's simultaneously sold at the higher price. Anybody that hears that will bring chair close to me. I say, Samuel, I will bring 100. So with that, I now have a competition. So what I was selling 150, I start reducing it to 140. So that I will get more customers. This guy will start reducing. Before we know, customers realize they are competitors here. Now why am I buying at 140? No, 120. And then before we know, everybody comes down to market price. That arbitrage opportunity has closed. Like competitors will walk out of the market. This market is not making sense again. Even someone that was giving me at 100k, when you realize this thing that is happening, someone too will bring chair and sell at 150k. Because it's not doing anything special, it's just sitting down. You get, so that's the arbitrage relationship. So people that invest in FX, that look into the market, so these opportunities exist if you study the market at different opportunities. So they try to take advantage of that opportunity before it closes. And of course, the more money you have, the better for you. If somebody is investing $1 million and somebody is investing 50K, it's not the same return, it's not the same investment. And there's somebody that's putting $1 million can likely move the market more than somebody that's putting 50,000. You get, so that's how transactions like this happen. So while arbitrage opportunities may be rare, the reason is that when they do exist, they will be exploited rapidly. Because nobody wants to see money on the table and leave it. Therefore, we can use a no arbitrage condition to determine the current value of the derivative based on the known value of the portfolio of assets that has the same future payoff as the derivative. So what does that mean? We have said, okay, going back to all the things you have discussed, we said there's a spot price, there's a future price. So we can estimate that, okay, this future price can be this, so that there won't be an arbitrage opportunity. Because if we do a calculation, we realize that this asset is supposed to be valued at 100 in 3 months' time, and it's valued at 105. That's an arbitrage opportunity of 5. Everybody will rush towards it. They will not buy today. They will find a way to go and invest their money, get the money, put it on that asset, get the asset back, and pay, and make that difference. Let me also give another example. Let's assume that I'm owing West in dollars, and I'm in Nigeria. So normally, in 3 months' time, I have Naira today. I'm owing West dollars that I need to give him in 3 months' time. Normally, I should be able to carry that money, invest, put it in an investment that will give me a return, that will hedge my risk so that I can pay back West in 3 months' time, right? So ideally, the idea is, if it's 100K I have, if I put it in an investment that gives me 3%, and it gives me 3,000, for example. So at the end of the day, I get 103,000. I carry that 103,000 in 3 months' time and give West this money, right? But if the interest is, let's say, 7%, I put 100K there, it gives me 107,000. I will keep 4,000. I will give West his 103. So I've made money by no risk. I've just invested somewhere and collected my interest. You get it? So that extra money is seen as an arbitrage. So that gap must be closed. That's why your exchange rate must kind of be linked to your interest rate and everything. Everything has a way to link themselves together. I don't want to take us to economics, but everything has a way to link themselves so that at the end of the day, opportunities, they exist. The moment they exist, you close them down. That's why you see it's met rapidly. Okay? So we'll now use an example to explain what this is. Remember all these things we're assuming. We're assuming that there is no cost to it. That's why I said they are risk-free. Okay, so we can illustrate a no arbitrage pricing with a 1 year forward. So the forward price of this on the share and pays no dividend and is trading at the current price of this. So the spot price of today is $30. So we are considering 2 strategies. Portfolio 1. You buy a pure discount bond with a yield of 5% that pays the future price at this. The current cost of the bond is this 1/, because it's 5%. Additionally, you enter a forward contract on 1 share as the buyer. The forward contract has 0 cost. Remember we said it at the beginning, you are not paying anything for your forward contract. So the cost of the portfolio is this. Don't stress yourself about the formulas, we'll get to the figures. So at T1, the bond pays this, which will buy the share of this. So the payoff is this T time of 1 and spot 1. Portfolio 2, buy a share of $30 and hold it for 1 year. The cost is 0 and $30. At T1, that's 1 year after. The value of the share is S1, and this is the payoff of portfolio 2. I'll explain. So what it's saying, the no arbitrage condition, which is the law of 1 price, requires that the two portfolios with the same payoff in the future for any future value have the same cost today. So if two things are going to give me the same future value, meaning they must both cost the same today. If one costs cheaper, it means that everybody will flood to the cheaper one, and we'll both. So I'll buy something at 20 naira, you buy something at 15 naira, and then we'll go and sell it at the same 30 naira. It doesn't make sense. You get it? So that's what this is saying. So because of our two portfolios has a payoff of this, they must have the same cost at the beginning. That's T0. So the future price is $30. We can solve the non-arbitrage forward price at 31.5. Meaning that the forward price of this item needs to be 31.5. To better understand this, we'll consider two situations. So let's look at it. Two situations in which the price is greater than and less than 31.5. So we've established that 31.5 is the price that is supposed to be priced at in the future. We now want to look at the two scenarios. If it is not priced at that, don't worry yourself about this calculation. It's just the logic you need to understand. So if the forward price is 32, meaning we have now, somebody prices the forward and says he wants to sell the forward contract, and the price that he puts the forward contract at is 32, right? But we've done a calculation to say this forward contract should be valued at 31.5. So already we see that there is already a 0.5 increase between what it should be and what this forward price is. What does it mean? The profitable arbitrage is to sell the forward because the forward price is too high and buy a share of the stock. What does that mean? I will sell, the assumption is that I have this stock, or I short sell it. So I have this contract of forward price that is valued at 32. But I also have a forward price that I know that at the end of the day will be valued at 31.5. So I can sell this forward at 32, go and buy a stock that at the end of the day will give me 31.5 as benefit. Now what have I done? The 32 and the 31.5, I have gained 0.5 in return. That's what this is saying. So the profitable thing to do is to sell the forward because the forward is too expensive and buy a share of the stock. Remember, a share of the stock is $30. Then in year one, deliver the share under the forward contract and receive 32, which is the cost of the forward, and a return of 6%, which is higher than the risk-free rate. We can also view this transaction as borrowing $30 at risk-free rate of 5% to buy the share, paying 31.5 to settle the loan. The share delivered under the forward has a contract price of 32, so the arbitrager has the profit of this. So what does it mean? I have no money today now. I walk into the bank and say, okay, borrow me $30. And it's okay, this $30 at the end of the day will cost you blah 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 5%. So you need 31.5 to settle the loan. I say, okay, no problem, give me the $30. Carry that $30 in. I go and buy a forward contract. At the end of the day, I'm ready to collect my money. I go to the forward contract. Forward contract gives me $32 because that's the price. I take $32, I take 31.5 out of it and go and pay back the loan. I pay 0.5. I do not do any business. I just took something from here, put it here, because I know at the end of the day they are supposed to have the same value at the end. So that's basically what the arbitrage is. In the other way, if the forward contract is 31, which is less, it means in this case you are losing 0.5 or you are gaining from the other side. So in this case, instead of purchasing the forward contract, go and purchase the shares, get the balance, pay off the contract, and move on. So that's it. So the summary is that when the forward price is too high, the arbitrage is to sell the forward and buy the assets. When the forward price is low, the arbitrage is to buy and sell the assets. This is the summary of everything that we are saying for arbitrage. So you need to note this things. Okay? Replication refers to creating a portfolio with cash market transactions that has the same payoffs as the derivatives for all possible future values of the underlying. So replication is to ensure that you create a portfolio that balances it out, to ensure there is no differences. I don't want to waste a lot of time on this. So just to go to the formula. So the forward price that will prevent arbitrage is this. This is what you need. In all these stories, this is what you need. Spot price times 1 plus RF, which is the risk-free rate, raised to power time. So we will be given, let's see, so you'll be given a question and you'll be asked to calculate what the forward price should be. They will give you the spot rate, the RF, and the time. So it's for you to now say, okay, based on this, this is what the forward price is, and the forward price makes sense. And to say, okay, based on this forward price, there is an arbitrage or there is no arbitrage. That's what this calculation is showing you. Okay, so when we derive the no arbitrage forward price, which is this, we assumed there were no benefits of holding the assets or cost of holding the assets. So we are taking it a step higher now. We have said the arbitrage relationship is the relationship that exists between the spot price and the future price, where the risk-free rate over the period of time matches. That's what this is saying. So we're now going to add what we call cost of carry, which is now their assets. There may be a cost of holding the assets. So that cost of holding the asset needs to be factored into this because there's a time period which is 3 months, 6 months, 1 year. So the cost of holding the asset has to be factored into this. And then there's an opportunity. So is it a cost, is it a benefit? That's what we'll look at now. So we assume there were no benefits of holding the assets and no cost of holding the assets, other than the opportunity cost of the funds to purchase, which is the risk-free rate. Because this formula only looks at risk-free rates. Remember, we've spoken about spot rate before, we've spoken about future rate before. The only thing we have added now is risk-free rates. So any additional costs or benefit of holding the asset must be accounted for in calculating the no arbitrage price. There may be additional cost of owning the assets, especially with commodities. So for example, if you are dealing with yam or perishable foods, rice and all those things, tomatoes, there is a cost of holding it. You may need to insure the property where the house is. You may need to ensure that you water it and all those things to maintain it. So those costs has to be included in the future price, because you are not dashing. It's not, you are holding this asset. You have bought it today. You are going to sell it at a future price. So the idea is everything that it has cost you to hold that asset until you sell it has to be added to the price of the asset. It's basic. Just like transportation cost. We have transportation cost to an asset because I have to transport it from point A to point B. So that's what this is saying. So there may be additional costs of owning an asset, especially with commodities such as storage and insurance costs. You get. So this cost has to be added to this our formula to get the future price. So there may also be monetary benefits to holding an asset, such as dividend payments, equities, and interest payment for them. So, for example, if I'm holding a share down, and they are paying me dividends over 2 years, 3 years, if I'm going to sell that share in the future, it somehow makes sense that okay, I can deduct the dividend and sell it at the same price, for example. You get. I won't say okay, I want to sell it at the current price because I also now have gained from the assets. You understand? So that's where this formula is coming from. So I'll look at it, okay, I bought the assets for, I wanted to use cars as an example because the price of cars today is not realistic. So let's assume in our normal Nigeria, because we are not in normal Nigeria, we are in special Nigeria. You bought a car for, let's say, 2 million naira, and you've used the car for 4 years. Of course, when you want to sell it, you will not sell it for 2 million. You have used the car has lost value, the maintenance and everything you have spent on the car. However, you will also want to make a loss on the car at the end of the day. You get it? So if you are going to sell it at any future price, this risk-free rate is now looking at, okay, those 4 years you have used the car on a normal scenario, how would it have, how much would it be today? That's what this risk-free rate is looking at. You will now say, okay, this last one you have spent, but now I want to sell the car. I have to paint the car, I have to change the bumper. Are you not going to add that cost to the market value to sell it? That's what this is saying. You want to recover that cost, extra cost you have spent on the car. So it's okay, I painted this car. I want this car to be better. So I painted the car. So I will add it as part of the cost. Just like landlords. When you leave your house, you come back, you told you there was a question. Okay, what did you do in this house? Maybe the door, you just change door handle, or the paint toilet. You just do one small thing. To him, you say that small thing is why the value of the asset has come. You get it? Now, in terms of benefits, you now, same way we have added cost. You can now deduct benefits to say, to be fair, I've gotten a lot of money from this commodity. This share, I've gotten a lot of money. If I count all the dividend I've gotten from this, okay, I can deduct it and put it at market value to sell it. So that's what this is saying. So for these benefits, so holding commodities may have non-monetary such as convenience yield. If an asset is difficult to sell short in the market, owning it may convey benefits in circumstances where selling the asset is advantageous. So let me just go to one example that we have. Consider a case where we may have benefits but not cost. Okay, so we've looked at this S0 plus 1. So you see that this cost has been added. So this is the formula I wanted to show you. This was the original formula, S01 plus RF raised to power T. But now we are adding the cost, X0 plus the cost, the present value of the cost, before we now do 1 plus RF raised to power T. Because this is storage cost. If it was benefit, we would deduct the benefit. So you add cost, you deduct the benefit. Hence, we see that cost of holding an asset increases is no arbitrage forward price. So the cost at which I'm holding an asset. So, of course, mathematically, if you look at this formula and you look at this formula, this one will be higher. The solution of this will be higher because you have added something to it versus this one. So let's see an example. Consider a case where holding an asset has benefit but not cost. If it has benefits, are we adding or we are deducting? We are deducting for benefits. So returning to our example of 1 year, blah, 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 at $30. Now consider the cost of buying and holding the share that pays the dividend of $1 during the life of the contract. So in this case, blah, blah, blah. So the cost to buy and hold the stock with an annual dividend will be 30, which is the spot SO, the price today, minus the benefit, which is $1, times 1.05. The 5 is the 5 years, which is the time. So this is now our formula, 30 times 1.05 minus 1. This illustrates the benefit of holding an asset. This illustrates that benefit of holding an asset decreases its value. We've said that. So if you now have both a cost and a benefit, it expands your formula. So you add the cost, you deduct the benefits. Basically. That's summary of that. Let's see. So the idea is now the compounding, number of years, and all. So consider a stock index of 15550 with a dividend yield of 1.3%, continuously compounded. When the risk-free rate is 3%, continuously compounded. Calculate the no arbitrage 6 months forward. So 6 months is not 1 year. So meaning you will do 6 divided by 12. right? So that S0, 1 plus R, when you now have continuous compounding, you now have a new formula, which is this. So if you have your calculator, you know there is this exponential this thing you have to calculate. So this is what you use for this calculation. So the no arbitrage price of a long 6 month forward is this 1550, which is the stock today, times the exponential of this 3%, is the risk-free rate, minus the dividend yield. Why are we deducting dividend yield? Because it's a benefit. Remember, I said benefit, you take it out. And now raised to power what? This is 0.5. This 0.5 means 6 over 12. Because this time is always in years. But since they gave us 6 months, it will be 6 over 12. If it was 12 months, it would be 12 over 12, which is 1. If it was 9 months, it would be 9 over 12, which is 0.75. That's how they got this. Based on this, the no arbitrage forward price should be 1563. Okay? Then forward contract, we've looked at some of these things before. And we go from economics, we looked at this economics calculation before. In terms of exchange rates, interest rates, and how it affects this. So like we said, remember what we said about price and base currency? Do you guys remember in economics? So this is now used to calculate the no arbitrage forward rates. So this same formula that you have in economics is coming here as well. So this formula simply is spot rate. I don't know why it puts to the right, but you can bring it back to the left. Spot rate times 1 plus interest rate price over base currency. I remember we said, what did we say the base currency is? So in this formula now, what's our base currency? Let me ask as if I didn't teach you economics. The base currency is euro. We have said that the currency at the end is the base currency. Why the first one is the price currency? So what this is saying is risk-free rate is 3%. Risk-free rate in euro is this. Risk-free rate in dollar is this. And the current exchange rate is 1.1. We will examine the arbitrage transactions that establish the relationship by looking at trades for an investor based in the US that seeks to profit, blah, blah, blah. The investor borrows 100 USD for 1 year at 2%, exchanges the USD for euro. Do they have the calculation? Okay. And invest the euro for a 1 year at 3%, and then exchanges the resulting euro for USD. At the end of 1 year, the arbitrage will have, so this is just trying to follow the process of if you borrow in one currency, just like the example I gave, borrow in one currency, take the money, pay back in another currency. Are you having any arbitrage this thing? That's what this is saying. So you borrowed the $100, so you borrowed 100 USD for 1 year at 2%, and exchanges that USD for euros. He gets the euros and invests the euros at 3%, and then exchanges the euros back to USD. This was the example I gave you about the Naira USD pounds relationship. So as these transactions have no cost, there should be no gain from this transaction. Remember I said that. There should be no gain from this transaction related to simply investing in USD, blah, blah. If this is the case, this euro should equal 102 USD. So you see we are looking at two currencies. 93.6 euro, which is this euro, must equal the USD, which equals the USD and euro exchange rate of 1.09. This is the no arbitrage forward rate. So using that same formula, so this same 1.08, we can get it using the formula on top, which is 1.1, which they have given us, times our price, our base currency is euro, right? Meaning USD is our price currency. So 1.1 times, what's our risk-free for dollar? 2%. 1 plus 2%, 1.02. Divided by 1 plus 3%, 1.03. So this, that formula on top, this is how you calculate it. So this gives you the rate. So this is telling you that this is the forward rate that should occur based on these 2 risk-free rates. Anything other than this rate, an arbitrage opportunity exists. So he now says, okay, let's look at if an opportunity exists. So if the arbitrage has a forward contract to buy USD with a price of this, so he converts this USD to euros, then he exchanges 94 euros, you will get 102 USD, which is the amount owed on the original loan of 100 USD. The depreciation of the euro in the forward price just offsets the higher, and the arbitrage transaction returns 0. Because you are owing 102, when you finish all those transactions, you get to 102. With a forward contract rate greater than this, the arbitrage will have a profit. And the when is less than this, the arbitrage will profit from the opposite transaction. That's basically what this is saying. If we convert the effective annual rates with continuous compounding, you know, continuous compounding is where we now have this E, this exponential compounding. Still that 1.10, but now you have your risk-free rate, which is what we just, which is the 1.98 minus the 0.296, which is the compounding that they've given us here, these 2 figures. That will still take you back to what this forward rate is supposed to be. You get? So whichever calculation you use, so I would just advise you stick to this one, which is what you have learned in economics. Spot rate multiplied by 1 plus the interest rate of the price currency divided by 1 plus the interest rate of the base currency. Just stick to that calculation and you are good to go. Okay? Any questions? I know it feels a bit complex, but just stick to the basic things. Like I said, derivatives is not one of your... Is this my charger? Derivatives is not one of your core courses. So you need to ensure that the things just enter your head easily. And you get the tricks of passing the exam and you move on. So, like I said here, I've given you what you need here, which is this. And we also looked at 2 formulas. So this formula is what you need. We also need this original formula that we said. This S plus 1 plus RF. Then you need this one as well, which is the cost and the benefits. Then you need this one of exponential calculation. Those 4 formulas, that's all you need. Every other story is just there. And you need to know that when is a benefit, I deduct it. When is a cost, I add it. And you are good to go here. Okay? So let's take this as our final reading for today. I think after this we'll have binomial. Europe and do forward and futures. Okay. So pricing and valuation of forward contracts and underlying with the varying maturity. So this same thing we're going to talk about is what we just spoke about earlier. Just a little branch out of it. The course is not so wide, as I keep saying. It's the same things that we are talking about. Explain how the value and price of the forward contract are determined at initiation, during the life of the contract, and at expiration. If you remember, for a forward contract, we said you're not paying anything. It's when we get to options that somebody is paying something. You remember that. So consider a forward contract that is priced at a no arbitrage value, which is what we just spoke about, which is this formula. At initiation, the value is 0. Forget about these stories. The value is 0. Why is it 0? Because remember, you have not paid anything. It's just you have verbally agreed to do something. That's the contract. So there is no value in it. I'm not losing yet. I'm not gaining yet. I haven't put any cost on the table. Right? So the value is 0 at initiation. Now, at any time during the life, the value will be changing. Remember, we spoke about it in our analysis. That once the value is going up and down, buyer is gaining, seller is losing, buyer is gaining, seller is losing, seller is gaining, buyer is losing. That's how it will be fluctuating. So that's what it's saying. At any time during the life of the contract, the buyer give all these stories. This is simply the current spot price of the asset minus the present value of the contract price. Remember, we did this calculation. In that example where we used the 1,947, one person gives 250, one person loses 250, like that. So that's what this is saying. Don't worry about the formula. So how did they calculate the value during the life of the contract? The difference between the spot price and the present value of the forward price, like we did in our calculation. It's the same thing. Now, the value can be this value can be realized by selling the assets and investing in a future blah 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 in a pure discount bond at RF. These transactions end any exposure to the forward. At settlement, the proceeds of the bond will cover the cost of the assets at the forward price, and the assets can be delivered to cover the short position. All the story is that we have said the forward contracts has said we are going to do a transaction in 3 months' time based on a particular price. So what it's now saying is, because I know where this price is going to land in 3 months' time, I can go today and go and get a loan, invest in a bond or a share, get the money from it, and use it to pay what I want to pay in 3 months' time. There shouldn't be any arbitrage opportunity in that scenario, that's basically what this is saying, which is the same thing we have been saying all along. So all these stories still saying the same thing. If the forward buyer has a gain, the forward seller has a loss, and vice versa. Same thing we said earlier. So don't stress yourself about this formula. We've spoken about it before. In the more general case, where there are costs and benefits of holding the underlying, the value of the forward to the buyer is this, which is the same thing we just spoke about. Add cost, deduct benefit. Same story. But now we're just explaining it to say this is the value of the forward. So we've said value of the forward at 3 different points. The value of the forward at initiation is 0 because nothing is happening, we're just having conversation. The value during the forward is all those things we have explained. As one price is going up, as the price is going up, buyer is either gaining or losing, seller is gaining or losing, vice versa. The net is 0. That is during. At the expiration date, same thing. The buyer has gained or the seller has gained. Because now the contract has ended, it's time to now settle your contract. During is as price is moving, but at the end of the contract it has ended and everything has closed. You get what I'm trying to say? So that's value for forward contract in 3 different phases. So this one too is also for forward rates. Don't you spend too much time on this. Same situation we spoke about, but now for interest rates. Somebody is swapping 2-year forward rate to a 1-year forward rate. The gap in between, only just take it. But I don't want to confuse you guys, because there are many things here that are not core for what you do. Maybe for your level 2, yes, you can expand on that level 2. So forward rates are yield for future period. The rate of interest on a 1-year loan to be made 2 years from today is the forward rate. So I will need to explain this notation. The notation for the forward rate must identify both the length of the loan period and how far in the future the money will be loaned. So when you see, when this is what they will show you, F11, it means it's a 1-year loan, 1 year from now. When you see F21, it means that it is the rate for a 1-year loan. So the second number is the period of the loan to be made 2 years from now. So the first number is when is it starting. So this forward contract is starting 2 years from now, but for a 1-year period. Right? So same way, the 2-year forward rate 3 years from today is how many years from today? 3. And how many period does it cover? 2 years. So you have to note that. So this first one is the time versus today. and this one is the period covered. So this one is a 2-year forward rate, and this one is the time from today. That's basically what this is. For money market rate, okay. I'm coming. There's an example down. Yes, we'll use this example down. For money market rates, the notation is similar, 3M 6 months, meaning it's a 6 months rate, but 3 months in the future. So, okay. So this one now, so if we use our example before, okay. So this one is saying F21. So this 2 is that when is this forward contract going to start? It's going to start in 2 years' time, 2 years from today. Now, but the forward contract is for how many years? It's going to be a 1-year forward contract, but it's starting from today. This other one too is saying the forward contract is starting when? 3 years from today. So I'm entering a contract with you. We're in 2024, but the contract will start in 2027. And it will last for what? 2 years. So 2027, 28, 27, 28. 2 years. But we are starting the contract in 3 years. We are doing the contract today. Today is the date, but it's going to last for 3 years. So it's going to start at 3 years and last for 2 years. Our example of laptop, we're doing the contract today, but the contract is going to start when? In 6 months' time. So our one will be F0.5. Remember, it's 6 divided by 12, so F0.5. The question is how long will it last? Let's say it's a 1-year contract. So 0.5, 1. You get. So first is how long will it last? Sorry, first is when is this starting? Then the second one is how long will it last? So note it's a bit, it can be a bit confusing. But the first one is when is it going to start? And then the second one is how long will it last? So you have different forward contracts. You have forward contracts of 5 years. You have forward contracts of 10 years. It's not just 6 months or 3 months. People, this is what they do. They go into, so maybe before Tinubu entered, somebody would have gone into a forward contract. It's okay. For the next 4 years, maybe for the next 8 years, if you believe Tinubu will stay in administration, I'm going to go into a forward contract that dollar is going to be at this particular price. Well, I do 4 years. The next 4 years, dollar is going to be at a particular price. Well, let's see, he started the contract 2 years ago. So yes, Buhari is leaving, Tinubu is likely to come, okay. Last year, election and everything, okay, fine. In March 2023 was around when we did election, if I remember. Okay, March 2023, we know that Tinubu is going to enter. So now I want to do a forward contract. The forward contract will not start now, it will start when Tinubu enters. Right? Which was the end of 2023. I think June 2023 came in, May, June. So I come in March and I say, okay, yes, I want the contract to start from May when he enters. Meaning my first F will be the 3 months between when we agree and when it's going to start. Then I say I want this forward contract to last for 4 years of his administration. So my second number is 4 years. So it's starting now, but it's a 4-year contract. So that's what this is saying. Basically. Okay? So this is people do this for this as people's occupation. Because now people are looking into Q2. Q2 in the sense that they believe that all the reforms that Cardozo is doing. So if you are there, so what are you going to do? Okay. So an implied forward rate is the forward rate for which the following two strategies have the same yield over the period. Investing in the forward dates, rolling over the proceeds, it's still the same, so it's still repeating everything that we have said. I just want to see if we have.
I would say that senior does not have a return agreement. for a contract is there says this is the amount that will be paid as current price.
I don't think so. There may be a contract to say, okay, funds will be repatriated. But in terms of at what rates, I will be surprised if there's a contract that carries a rate. Because it doesn't, it's like that, the hedging we are talking about. It's like the hedging, government may not want to enter that contract. If they have entered that contract at 465, and they put it written in a contract that you repatriate your funds at 465, irrespective of 5 years time, 10 years time, government will be bleeding now. You will be bleeding now. So it's only the people that have said, okay, I want to go into a contract with you. Okay, 465. Okay, I will sign a contract with you at 500. Anybody that has signed 500 contract how many years ago will be saying what's wrong with you. The exchange rate is 465. But if the person has forecasted that, man, the way Nigeria is going, this thing will be killing. 500 is a mad deal today. Imagine getting dollars at 500 now, compared to somebody getting dollars at 1,005. If you have invested in a dollar asset, and you have left it, in fact, what am I saying? 1 year, you have almost doubled your investment. We're talking of December close 970, early 2023, we were at 7 something. The mid 2023, 7 something. We are at 1415 now. That's 100% on your dollar. You have, that's what you call risk-free return. No risk, your money is just there, just doubled. So that's what we are talking about. So you that have a dollar investment, you have gained. But you that have an investment in that, imagine somebody importing, look at the cost of cars. I was talking about cars some minutes ago. A Toyota Corolla or Toyota Camry that, let's say 4 years ago, was around 2 million. So I know a friend who used this Toyota Camry 4 years ago. He bought it 4 years ago. He has used it for 4 years, bought it like 2.5 million. Nigeria, Tokumbo, bought it Tokumbo. He has used that car for 4 years in Nigeria. That car is 4 million. Nigerian used is 4 million. That's not logical. Normally, you have used the car for 4 years, 2 million. If you sell it 1 million, you'll be saying, oh, thank God, I'll gather money to buy. But now, that car is more than the cost you bought it. And why is it like that? Because if you sell that car for 4 million, to buy a Tokumbo of that car is 8 million. Okay, so consider 2-0 coupon bonds, one that matures in 2 years and the one that matures in 3 years. The 2 years one is 2%, the 3 years one is 3%. Calculate the implied forward rate 2 years from now. So 2 years from now is the F2. That's why the 2 is the first one, which is 2 years from now. But it's a 1 year yield. So the 1 year is, we have been given one that matures in 2 years and one that matures in 3 years. So the 1 year in between is what we want to calculate. So that's what this graph is saying here. So this one is the period, year 1, year 2, year 3. I want to calculate. So year 0 is where we start from. But we said this contract is going to start 2 years from now. So it's going to start from year 2. And we have been given year 2 and year 3 as 2% and 3%. I want to calculate the 1 year in between. So that's basically what this is saying. So lending $100 for 2 years at 2% results in this at 2 years, while lending this results in 109. So the difference between the 109 and the 104% is the 5%. So this 5% is the implied rate between year 2 and year 3. We're almost done, just 2 minutes. 2 minutes, we're almost done. So this is the implied rate between year 2 and year 3, which is this one that is shaded here. So remember, they said calculate the 1 year forward rate 2 years from now. So that's why we have F2. F2 is the time from now, which is 2 years. But the period of the forward rate is 1. That's why you see F21. But they didn't give us the 1 year rate. They gave us the rate 2 years from now and the rate 3 years from now. so that we will calculate the gap between the two. So that's what this is saying. So we calculated the 3 years from now and 2 years from now. And we said the gap between the two is a 5.3. So this is the implied forward rate between year 2 and year 3, basically. Okay. Same thing for these 3 months and 6 months. Same direction. I don't want to overborder us. Yeah, that's basically that. Yeah. So we'll continue with the pricing and valuation of futures contract next week. So I think by next week we should be done with derivatives, give or take. It's not a lot. All right. Thank you, guys. Enjoy your week.